Well, hi, everyone, and welcome to Buffett and Beyond Research Stock of the Week. And this is November 2nd, 2024. We're going over a stock called Fair Issac, and it's up almost 600% in 5 years and about 140% in the past 1 year alone. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at this stock because this is one that I bet most people never heard of, and it's called Fair Issac Corporation, provides decision-making solutions to clients in the financial services, telecommunications, and retail industries. And the company's main products are rule-based analytic tools designed to make businesses more profitable. Well, that's what everybody wants. And the company offers application-optimized servers and storage system for various markets, including enterprise data centers, cloud computing, artificial intelligence, fifth generation, that's 5G, and edge computing, and has about 5,126 employees. And folks, that all sounds nice, but let's see if this company's making any money. And when we compare it to the average stock, now Fair Issac is in green and the average stock is in blue, and we're just looking at three things right here before we go on to more intricate statistics. The clean surplus return on equity, which remember is much different than the traditional accounting return on equity. And, well, we can see that Fair Issac has 21.6% versus the average stock of 13%. And just think about a bank account. If you were to put your money in a bank, would you want one paying you 13.5% or one paying you 21.6%? I don't think there's much of a chance that you would go with the average stock out there. Now, when it comes to net income, and net income means the amount of money the company is bringing in, it's the clean surplus earnings. So it's not traditional accounting earnings, they're clean surplus earnings. In other words, what is the company making in its core business and bringing to the bottom line? And what is it? Well, 26.2% versus the average stock at 13%. That's twice as much for Fair Issac bringing in money to the bottom line than the average stock. So that's why it's outperforming the average stock out there. And when it comes to revenue, making almost twice as much, or I should say bringing in almost twice as much, and you got to bring in revenue in order to get that revenue to the bottom line, and it's the bottom line that dictates the price of the stock. So let's go over the numbers just a little bit more in depth, and we want to look at the net income. And again, these are the clean surplus net income, not traditional accounting earnings. And we can see that no matter how you look at it, they've been going up every year since. Wow, just beautiful. And that gives us a clean surplus ROE above the average clean surplus ROE. Now down here, back in 2016, 2017, 2018, it was about the same as the average stock. And then all of a sudden it really came on board and started making money with that clean surplus ROE going up. Now what does this actually mean? It means that the company is making money, but it's making money at an increasing or accelerating rate. And boy, oh boy, the market loves that. They see this acceleration and they say, that's where I want to be in a stock like this. Retention rate, they're taking all the money they're making, putting it back into itself in order to grow. And here's that net income and the revenue growth once again. And you can see the 5-year averages are way more than the average stock. Revenue growth twice as much as the average stock. So it's doing very, very well. Years to pay debt, about 3.5%, or about 3.5 years, I should say. And this is Buffett's rule of thumb. He says if a company takes all the money it's making and puts it back into itself in order to pay off debt, how many years would it take to do that? What he looks for is his average years to pay debt is 5 years or less. Ours is about 3 years or less. So we're right in the ballpark right here with the years to pay debt. And of course, it's paying no dividend because it's putting all the money back into itself in order to grow. And what we're adding to our computer program now is what ETFs is the stock in. And with this ETF and Fair Issac, we are in the XLK, which is the technology ETF. So it's a technology stock, folks, and boy, technology has been hot. And I went back many, many years when I look at these stocks, even further than 2016. I go I go back at least to 2010, so we're looking at 15 years minimum that I look at, and technology has always led the way. So these are the kind of stocks that you want in your portfolio, because these are the ones that do the best. And as long as they stay good stocks, like something like Fair Isaac, we would keep this in our portfolio. It's not in our portfolio right now because I just came across this stock recently and have been watching it. So we'll see what it does. And what has it done over 1 year? Well, the black line is the S&P 500, and you can see it's up a little under 40%, and as I'm recording this, the market is getting hit right now, and Fair Isaac is up about 140%, so it's up three times that of the S&P 500, of the average stock out there. What a beautiful run this stock has had over 5 years. Yeah, you can see that back in the early years it was outperforming the S&P 500 a little bit for the most part, and then all of a sudden those earnings started coming in really, really high and fast, and this stock took off just a couple of years ago, and boy, oh boy, is it doing well. So folks, this is a pretty good stock, and we're going to keep our eye on it to see if it's going to go in our 2025 portfolios, or any of those our portfolios. So folks, here we are. We had a tough week. We saw the end of the month and the beginning of the new month. And remember, if you want to walk on the beach at sunrise like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Okay, folks, you go out, clear your head. Don't worry about the market, because it'll be back here on Monday morning. You stay safe. Have Sunday dinner with your family. And folks, we'll see you back here in a couple of days.